The numbers are in, and they are unprecedented. The London Bullion Market Association just released their annual forecast survey. What the world's top precious metals analysts are predicting for silver in 2026 has never happened before in survey history. The average forecast, $79.50. A projected rise of 98.8%, nearly doubling. But silver is already trading at $95. That means 9 out of 26 analysts have already seen their high predictions breached. And we are only 3 weeks into the year. Into the highest forecast, $165 per ounce. Not a typo, not a meme, a professional analyst putting their reputation on the line. Why? Why are the same analysts who missed last year's rally by a record margin now making the most aggressive forecasts in 20-year survey history? Are they chasing momentum, trying to save face? No, they see something fundamental, structural, permanent. Silver is no longer being priced as a commodity. It is being priced as a strategic asset. And once that repricing completes, 165 will look conservative. This is not just about price targets. This is about the breakdown of consensus, the death of normal, the moment when experts looked at data and realized their old models no longer apply. The LBMA survey has run for over 2 decades. It polls top analysts from banks, refineries, trading houses. These are institutional professionals whose careers depend on getting calls right. For 20 years, forecasts clustered around reasonable moves. 5% up, 10% down, normal behavior. But 2026 is different. Consensus calls for doubling, and forecast range is wider than ever. Lowest low, $42, highest high, $165. That spread alone is larger than the entire price of silver 3 years ago. This is not consensus. This is chaos. A market that experts openly admit they no longer understand using traditional frameworks. And when experts are confused, when models break, that usually signals something massive happening beneath the surface. Last year, LBMA consensus for silver was $32. Actual average price was $40. They missed by $8. Largest miss in survey history in both dollar and percentage terms. They underestimated by 25%. So this year they went opposite direction, most aggressive forecast ever, because they looked at 2025 and realized it was not fluke. It was beginning of regime change. Silver rose 147% in 2025. Best annual performance since 1979, 46 years. For context, 79 was year of Hunt Brothers silver squeeze. Year silver went parabolic to 50 before crashing. Only comparable year in modern history. But difference. Hunt Brothers were speculators trying to corner market with leverage and borrowed money. When exchange changed rules and hiked margins, they collapsed. Move was artificial, unsustainable. 2025 move was not driven by speculators. It was driven by structural deficits, industrial demand, export restrictions, central bank buying of gold spilling into silver, geopolitical tensions, currency debasement, not temporary factors, permanent shifts. And analysts see this. That is why they are not calling for pullback. They are calling for acceleration, because forces that drove silver up 147% last year are intensifying in 2026. Let me break down the forecasts. The average target is $79.50, but averages hide extremes. Let me show you the outliers. Ross Norman, a former banking and refining executive, is one of the most respected forecasters in the LBMA competition. He has been doing this for years. He has won the competition multiple times. His forecasts are usually conservative, measured. This year, Ross Norman called his own forecast outlandish. He admitted it was extreme, but he submitted it anyway. Why? Because he looked at the supply deficit. He looked at China's export restrictions. He looked at the industrial panic buying. And he concluded that normal price behavior no longer applies. And Ross Norman is not alone. 3 other analysts submitted forecasts that are even higher than his in gold. 1 analyst submitted a forecast higher than his in silver. These are not fringe voices. These are institutional professionals who are paid to be right. Bank of America released their own forecast earlier this month. They said silver could top out between $135 and $309. $309. Let that number sit with you. That is more than 3 times the current price. That is silver going from a precious metal to a monetary reset event. And Bank of America did not pull that number out of thin air. They built a model based on historical gold to silver ratios, industrial demand growth, and deficit trajectories. And their model spit out 309 as the upper bound of possibility. Now, you might be thinking, these are just forecasts. Analysts are wrong all the time. And you would be right. Analysts are wrong constantly. But here's the key insight. Analysts are usually wrong in the same direction. They cluster around consensus. They herd. When the entire herd suddenly breaks in the opposite direction, when consensus shatters and the range of forecasts explodes, that is not random. That is a signal that the underlying market structure has changed, and the herd is scrambling to catch up. Let me show you what changed. Let me show you why the analysts went from missing the move by $8 last year to forecasting a doubling this year. Because the facts on the ground are undeniable. Fact 1. The supply deficit is structural. Silver mine supply has been flat for a decade, around 830 million ounces per year. That is the ceiling. You cannot mine more silver by wishing for it. It takes 10 years to permit and build a new mine. Even if silver goes to $200 tomorrow, no new supply is coming until 2035. Meanwhile, demand has exploded. Solar panels, electric vehicles, electronics, 5G infrastructure, artificial intelligence data centers, all of these technologies require silver. And all of these sectors are growing exponentially. The Silver Institute estimates the deficit for 2025 was over 200 million ounces. That is 25% of total supply. Imagine if 25% of the oil supply disappeared. What would happen to the price? Fact 2. China controls the flow. China refines 60 to 70% of the world's silver, and on January 1st, 2026, China implemented export licensing restrictions. Only large, state-approved firms with proven export records can ship silver out of the country. Small and mid-size exporters have been cut off. This is not a temporary rule. This is a permanent strategic shift. China has classified silver as a critical mineral. They are treating it the same way they treat rare earth elements. Secure domestic supply first. Export only when strategically beneficial. And here's the proof that it is working. The Shanghai Silver Premium. Right now, silver in Shanghai is trading about $10 higher than in New York. $10, that is a 15% premium. In a normal market, arbitrage traders would close that gap instantly. Buy in New York, ship to Shanghai, sell for profit. But the gap is not closing. Why? Because the metal is not flowing. Chinese buyers are paying the premium because they know they cannot get the metal any other way. And Western sellers are holding because they know that once their inventory is gone, they cannot replace it. This is what a broken market looks like. A market where the paper price and the physical price have divorced. Where the screen shows 95, but the dealer charges 110. Where the laws of arbitrage no longer function because the physical bridge has been severed. Fact 3. The industrial panic is real. This is not speculation. This is not investment demand. This is companies that build real products realizing they cannot function without silver. And they are buying at any price. Jupiter Asset Management said it clearly. Silver is basically disappearing to China and India. There is about a $10 premium being paid in Shanghai. The silver market is now all about physical bars. If you do not have silver, you cannot build anything. Whether it is electronics, white goods, missiles, or cars, you do not have it, you cannot have it. Think about that. The head of a major asset management firm is saying that physical silver is disappearing. Not declining, disappearing, being removed from the market faster than it can be replaced. And the companies know this. Tesla knows this. Apple knows this. Samsung knows this. They are looking at their supply chains and seeing red flags everywhere. Their suppliers in Asia are telling them delivery times are stretching from weeks to months. Premiums are rising. And there is no guarantee that orders placed today will be filled tomorrow. So what are they doing? They are stockpiling. They are switching from just-in-time inventory to just-in-case hoarding. And when industrial giants start hoarding a metal that is already in deficit, the price does not go up linearly. It goes exponential. Fact 4. The U.S. Mint just paused silver coin sales. Let me repeat that. The United States Mint, the official producer of American Silver Eagles, the most popular silver coin in the world, paused sales. Why? To reprice them. The Mint buys silver blanks from suppliers. Those suppliers source from refiners. And the refiners are telling the Mint that the old pricing structure no longer works. The cost of acquiring physical silver has risen so sharply that the Mint's existing inventory agreements are underwater. So they paused. They are renegotiating. And when they restart sales, the price will be higher. Significantly higher. This is not a normal market adjustment. This is a supply crisis hitting the retail market. And here's the implication. If the U.S. government cannot secure silver at stable prices, what does that say about the availability of metal? It says that the shortage is not theoretical. It is here, now. These 4 facts: structural deficit, China restrictions, industrial panic, mint shortage. These are the reasons why analysts are forecasting 165. Because they are looking at a market where demand is vertical and supply is zero. And in that environment, price is the only mechanism to ration scarcity. But there is a 5th fact, a fact that is harder to quantify, but perhaps more important than all the others: the monetary factor. Because silver is not just an industrial metal, it is a monetary metal. And in 2026, the monetary premium is coming back. Look at what happened this week. Gold hit $4,813, a new all-time high. Why? Because of the Greenland crisis. because Trump threatened tariffs on 8 European countries, because the Federal Reserve Chair is under criminal investigation, because investors are fleeing dollars and bonds and rushing into hard assets. Gold is leading. But silver is the leveraged play on the same trade. Historically, when gold rallies due to monetary instability, silver outperforms. The gold to silver ratio compresses. Right now, that ratio is around 50 to 1. Historically, in crisis moments, it drops to 15 to 1. If gold is at 4,800, the ratio drops to 15. Where does that put silver? $320. That is not a forecast. That is just math. And that is why Bank of America put 309 as their upper target, because they are modeling the possibility of a ratio compression to historical norms. And here is the critical insight. The ratio compression does not require gold to go higher. It just requires silver to catch up. If gold stays at 4,800 and silver goes to 165, the ratio would be 29, still well above the crisis level of 15. This means that even the most aggressive silver forecasts are assuming that silver does not fully catch up to gold. They are assuming that silver remains undervalued relative to its monetary cousin, which means there's room for even more upside if the monetary crisis deepens. So let me bring this full circle. The LBMA analysts are not chasing a bubble. They are not extrapolating a trend. They are looking at a market that is fundamentally broken and trying to estimate what price is required to fix it. To fix the market, one of two things has to happen. Either demand has to be destroyed or supply has to be created. Demand destruction means silver goes high enough that companies stop using it. But as we discussed, silver is irreplaceable in most applications. You cannot build a solar panel without it. You cannot build a smartphone without it. So demand destruction requires prices that would collapse entire industries. $200, $300, maybe higher. Supply creation means new mines, but new mines take a decade. So supply creation is not a solution for 2026 or 2027 or even 2030, which means the only equilibrium is a price high enough to ration existing supply among desperate buyers. And that price, according to the analysts who study this for a living, is somewhere between 80 and 165. And here's the final kicker. Silver is already at 95, which means the low end of the forecast range has already been exceeded. The average forecast of 79.50 has already been breached. 9 out of 26 analysts have already seen their high predictions surpassed. And we are 3 weeks into the year. 3 weeks. There are 49 weeks left in 2026. If silver is at 95 in January, where is it in December? The analysts are telling you the answer. 165 is possible. 309 is possible. Not guaranteed, but possible. And in a market this dislocated, this supply constrained, this geopolitically charged, possible becomes probable faster than anyone expects. This is not speculation. This is not hype. This is the most respected forecasting body in the precious metals industry telling you that the rules have changed, that the old models are dead, that the price of silver is going to a place it has never been before. And if you are sitting on the sidelines, if you are waiting for a pullback, if you are thinking that 95 is too high, then you are ignoring what the experts are screaming at you. The pullback is not coming. The dip is not coming. The market is not going back to normal. Because normal is over. The LBMA just told you that in the loudest way possible, with forecasts that are beyond outlandish, with predictions that their own members admit sound crazy. But crazy is the new sane, and 165, is the new target.